protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
Welcome to the Money Unleashed podcast. I'm Eric Johnson, joined as always by Kyle Allyn, and we are the vice presidents of Hoffman Financial Group. We bring you new episodes every Monday and Friday, so be sure to subscribe wherever you get your podcasts. All right, Kyle, so we're going to talk about how retirement plans are changing, right? And are you ready to seize this opportunity? This is going to be surrounding around 401ks. 401ks are good. They got some really good pluses and bright spots to them, but they also have some not so great features to them as well. We're going to touch the bases on all of these. And the reason why we're talking about 401ks, guys, is because most Americans have one. The problem with these is that you might have 10 to 20 selections inside of these. They're all mutual funds. They all have expense ratios, which you pay money for inside of it. P.S. It's why you have a match. It's not because your company loves you. The match is to pay for the internal fees inside the 401ks. But the problem is with these mutual funds is people have no idea what they're actually invested in. That's why it's so dang important to have these looked at. We want to analyze these. We want to figure out what sectors that you're in the stock market. We want to figure out what's working and not working so we can improve the performance of your portfolio. So I'm going to let you kick it off, Kyle. Let's talk about a few things about 401ks.
Yeah, so 401ks were started on November 6, 1978, and the 401k was essentially designed as this tax-deferred vehicle to be able to put money into. That way you didn't have to pay taxes on the front, and you could pay them later. And so the idea was fairly simple. Taxes are high when you're working. You're trying to make more and more money. Of course, as you make more money, you report more income, and you pay more taxes. Well, if you could defer some of your tax into a vehicle, such as a 401k, then you would be able to pay them later, and the assumption was when you retire, your taxes are lower. And that's generally true because people aren't spending as much money in retirement. Of course, they're not pushing to higher and higher levels of income. So let's say you're working, making $200,000, you get into retirement, maybe you're only spending 70, 80, 90 grand, right?
Yep.
So then we take ourselves into, sort of what has been happening with these things, right? So we look at the 401ks, and we have an article here, and the article is essentially saying that people are frustrated with the process of the 401k. So they're saying, okay, it's mostly about saving, it's mostly about products, but we want planning, right? So we see this article, and it says today's workforce isn't satisfied with the standard 401k for their retirement planning. They want a holistic financial experience. I'll say that again. They want a holistic financial experience. That's not what you get with the 401k.
Yeah, you're not touching all the bases with a 401k.
It's not holistic at all.
Let me see if everybody out there knows this experience. You get a prospectus once a year, and it says, what do you want to do? And it gives you a list of all these mutual funds with no explanation of what they are other than the name. So I'll call one out I see all the time. American Funds, Euro-Pacific, R6 Growth Fund. People have no idea what's in there, right? So what do? They naturally go to the numbers, which they have nicely set up for you off to the side and say, oh, this is averaging 15% a year. I'm going to put some in here, right? Or they might have one where it's like, it might be a bond fund. They don't even know it. It just says the PIMCO income fund. They go, income, that sounds good. Well, you see PIMCO, that's a bond fund. Or you might have a target date fund. And these are one of my least favorites. And the target date fund, when they first came out, 20 years ago, they were kind of cool because they give you a little bit of a mix of everything. Give you some bonds, give you some stocks, and then all of a sudden they started taking American stocks and putting more international stocks, and then every year you get closer to the target date, they put more bonds in for you, which is not exactly great because they're not inflation adjusted. And bonds, if you're looking at the AGG, which is the bond index, it's averaging like 1% over the last 5 years. Not wonderful, right? So I would argue there's a lot of antiquated positions that are in there. They're also quite expensive. And yeah, people want a little bit more than that. More than, hey, what do you want to do? Like they're the financial professional that understands all this stuff that's being put in front of them. They're simply guessing, right? Well, why is this a big problem? Well, I see people over-investing inside of the mutual funds that are inside of the 401ks. And what does that mean? I mean, if I had a nickel for every time someone came into my office and the majority of their portfolios in 401ks, and they've got 20 different mutual fund positions selected, that's basically going to guarantee that you're probably not going to get very robust gains. And why is that? Well, because if we can agree that in every single mutual fund, Kyle, that there's anywhere from 500 to perhaps 4,000 or 5,000 different positions, you're going to be spread so far, so thin that, you're not going to do as well as simply putting in an S&P 500 type of fund. That's one big problem that I see and why it's critical to have it looked at. What are some other ones that you see?
Well, there's diversification within those platforms that you don't even know about. So you may say, well, no, I'm in stocks. And they're American stocks. Okay, well, what is their market cap? Are they large cap stocks? Did you know that there are also small cap stocks, right? So if we look over the last 5 years, we can see that the small cap stocks only made 7% return. So had you been in the large cap stocks, the S&P 500, you would have made a lot more money.
Yeah, almost double.
Almost double. We look over a 10-year period, they're still lagging. So there are these things inside your portfolio for diversification purposes that give you the ability to have a more balanced portfolio, and you didn't even know that's why you had that in there. So it's hard for people sometimes. They're dealing with the reality that the 401k was designed in the late 70s, implemented in the 80s. Your parents, if they worked and saved, they'd used a pension. And so you don't have anyone teaching you, showing you, leading you on what to do. We've also talked about here on the show that the baby boomer generation is the first generation ever of this massive wealth expansion. So if you look at the inheritance coming towards the baby boomer generation,
massive.
Well,
for Gen X, it's massive.
That's right. The one they're giving to Gen X is the big one, right? So they're getting or got $4 trillion, but they're giving away 80.
Yeah.
So you live in this world as a person who is 60 to 70 years old, and the people before you couldn't have told you about this because it didn't exist. They couldn't have told you about this because they use pensions and use 401ks. They couldn't have told you about this because they didn't have money and you do. So here you are trying to navigate this system. And so what we're trying to coach, teach, and help people learn is the details matter. If you don't know the details of your portfolio, you need to get a portfolio x-ray. That will give you the clarity to understand what you're in. This idea that you can set it and forget it, I understand that you're making money. But I had a client come in yesterday, a prospective client. They sat down with me and they said, I've been doing amazing this year in the stock market. I said, great. Did you do better than 15%? They said, no. And you could just see the color drain out of them as they admitted to themselves in that moment in front of me that they didn't do as good as they thought. They go, what do you mean 15%? I said, well, the S&P's up about 15%, give or take the day.
So that I want to interrupt you for just a second. That outlines another problem that I see with these 401ks. We use benchmarks for everything. That's how we know that answer. So if you're all in stocks and we look at the S&P 500, and that's made 15%, but yet your portfolio is made 10%, that's a big problem because nobody knows what their benchmarks are inside of their 401k.
And 10% is good. If you got $1 million in your 401k and you made $100,000, I mean, who's to say $100,000 in your pocket isn't fun? But did you know that you could have made $150,000?
That's exactly right. So that's why it's so important to have the portfolio x-ray so we can go in and make the appropriate tweaks, especially if there's no way that we can manage that for you. I do it all the time. Like, this is not a zero-sum game. You could go in there and you can change the S&P 500 and do much better in just one mutual fund than having those 15 that I keep seeing all the time when people come in here.
Or you can just get rid of it. It's a terrible investment from the standpoint of performance, even though it's an incredible investment from the standpoint of savings. So if you're 59 and a half, I just want to make this really clear.
That's a big age.
That's a big number. At 59 and a half, the vast majority of listeners that are listening to our voice here today, you can get out of that 401k. And Eric says it all the time. You got a Corvette with a Pinto engine. Let's put a V12 in that sucker. That chassis can handle it.
Hold on a second. Where can you put that 401k?
You can put that into an IRA.
Is that taxable if you move it out of there when you do an in-service distribution that we're talking about?
As long as you do it the right way, you've got a 60-day window. You can do the rollover. You can move it from the 401k to the IRA. That's right.
That's right. So we're telling you that if you're 59 and a half and you've got a current 401k, you now have an opportunity to roll the majority of it out to an IRA. And why is that such a big deal? It's because you have a much more robust way of growing it and protecting it inside of an IRA than you would in the 401k. You can eliminate all those expense ratios.
And let me pause this because a lot of times when we say that to clients, the first thing they hear is, well, if I get out of the 401k, I don't get my match anymore.
Nah, not so. We always keep the 401k open.
That's right. It's an in-service withdrawal. So you keep the 401k in service. We keep using it as the vessel that's taking the money from your paycheck into the 401k to get the match, but we withdraw out the principal. So let's say you've got $300,000 in your 401k and you're 60 years old.
Yeah.
We can roll the $300,000 out, but leave the 401k open. So what's going to happen here is as you're continuing to work, you're going to continue to contribute to that 401k. But that large nucleus of money, that principal, we're going to be able to put into an IRA, and then the world of investing opens up. So these things that we're talking about outside of just mutual funds, you would have access to them with that $300,000. The new money that's rolling in, let's say you're putting $5,000 each year, that would go into the 401k, and we would help you access and put together a strategy on that smaller amount inside the 401k. So we're going to guide you for free on the 401k. We're going to help you over at Fidelity, who is our custodian, manage the IRA. And so that's going to allow you to get both pieces moving. You're going to get the match and you're going to get the performance. So in this case, you get to have your cake and eat it too.
That's absolutely right. You always want to make sure you're keeping that 401k open. You don't want to step over the match. That's free money. And you also want a landing place for your contributions every 2 weeks as well too. But yeah, it's something that we also do. Like if we go ahead, we move something over to an IRA and create a better growth plan for people, everyone's like, well, how do I add to this? I'm like, no, you keep adding to your 401k, and then we've got ways to cost average using the plans that we make internally, right, for your growth plan that we do for you. Meanwhile, you're doing the same thing and adding on the other side. And when you actually do retire, then you grab the rest of the 401k, add it to the plan, and boom, now you're ready for a fantastic, successful retirement.
And I'll give you something interesting, because I just had this conversation yesterday. A guy said, I'm working with Vanguard inside my 401k. I've talked to them about some of the newer things that you guys talked about that we can do if we do the in-service withdrawal and roll out to an IRA. And he said, but my Vanguard guy said I shouldn't do that. And I said, well, let me just pause you for a second. And I Googled it and I said, all right, what do you think the revenue is for Vanguard? It's $10 billion, $10.3 billion. Can you imagine why Vanguard is telling you to not move that money out of the mutual funds that they're using and the ETFs that they're using? It's not that there aren't better things in the IRA and in the world of investing. It's that it's advantageous for them for you to stay in the 401k. And he goes, oh, that makes sense. So once again, there's nothing wrong with the 401k. It's an amazing vessel for saving money, getting you started. We know that. It's my nephew with the training wheels on. It's time to take the training wheels off of the bike. You've built a good muscle memory of how to ride this bike, but you don't need the training wheels anymore. We can take them off and you can go so much faster because you are prepared for this moment. You are ready for this moment. And I know that you're nervous, but that's what we do. We'll guide you through how to build an IRA, how to get the right things in it, and how to maximize performance for these tax-deferred assets.
That's right. So if you do have a 401k, doesn't matter if you're current, doesn't matter if it's an old one, doesn't matter if you're getting ready for retirement. Get on in here. Let's get a portfolio x-ray done for you. Let's figure out what exactly is inside of here and how to make it better. Give us a call, 404-640-5511. That's 404-640-5511. Or you can find us online at unleashyourmoney.com.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.